If you're tired of losing your hard-earned money on failed prop firm challenges, then look no further. In this video, not only am I going to show you how to pass FTMO challenges, but I'm also going to teach you how to pass the challenges of other leading prop firms in the industry, such as my Forex funds and the 5%ers, amongst a host of others. So keep watching. Now, in order to pass the FTMO challenge, you're going to need two things. The first of which is a sound risk management plan, and the second is a profitable Forex trading strategy. So the way this works is we're going to be using asymmetric compounding, because when we use asymmetric compounding, it's going to take an average Forex trading strategy and give it that power which you'd need to pass the FTMO challenge in only 2 trades. That's if you have 2 consecutive winning trades. And even if you were to have like 6 losing trades in a row, with only 2 consecutive winning trades, it's more than enough to bring you back above break even.
Why don't you explain this to me like I'm 5?
So let me explain what this means to you. Let's assume that you take a trade and you're risking 1% of that account's balance per trade. And the trading strategy you're using uses a 1:3 risk to reward ratio, for example. Now, that would simply mean that whenever you take a trade, you'd be risking 1% of that account's balance, and then you'd be aiming to make a profit of 3%. So if that trade turns out to be a winning trade, then you're going to make 3% in profit. So 1% is your risk, and then your profit from this winning trade is going to be 3%, since you're trading with a 1:3 risk to reward ratio. Now, if asymmetric compounding is what you're using, that's your risk management strategy, the next trade you're going to take, you're going to actually risk the 3% winnings you made from your last winning trade, and you're also going to add on that 1% which you usually risk on this account on every trade you take. So in this particular instance, you're going to end up risking 4% on this trade. And since you're aiming to make 3 times what you're risking on each and every trade you take because of the 1:3 risk to reward ratio, you're going to end up with a profit on this trade, if it turned out to be a winning trade, of 12%. Now, with this profit, this is more than enough to help you pass any prop firm challenge, especially FTMO, which requires you to have a 10% win. Okay, my Forex funds is only 8% and all of that. Now, here's where it gets interesting. Let's assume that your first trade was a losing trade. Okay, so you risked 1% and you lost. Now you're down 1% on your account. Okay, let's say on the second trade, you also risked 1%, because with this money management strategy, when you lose a trade, you are going to need to revert back to the default risk per trade on that particular account. So for this particular example, the default risk per trade is 1%. So you lost the first trade, you're still going to be risking 1%. And let's assume you lose that second trade also. Now you're down a total of 2%. And let's say again, you take another trade, which is the third trade, you're risking 1% to make 3%. And this trade turns out to be a winning trade. Now guess what? Let's assume that what you made on this trade was 3%, because you're risking 1 to make 3. Now you're going to be up 1%. Okay? Why are you going to be up 1%? Because from those previous 2 losing trades, you had minus 2%. Okay? And then now you have 3% in profit. So this is going to give you a plus 1% profit after taking 2 losing trades and 1 winning trade. Now let's assume that the next trade you take is also a winning trade. But here's the thing. On the next trade, you're not going to be risking 1% because you're using asymmetric compounding. So you're going to risk 1% plus the 3% you made in profit on the previous trade. And now if this trade turns out to be a winning trade, you're going to end up with a profit of 12%. Okay? On this particular trade alone. And your total profit is going to be 13% only after taking these 4 trades.
Sounds like a get-rich-quick scheme.
Yes, thank you. You will get rich quick. We all will.
Again, to show you the power of asymmetric compounding, imagine you were trading with a trading strategy that had a 1:2 risk to reward ratio. So every time you risked 1% of your trading account's capital, you are looking to make 2% as a return on investment on your winning trades. Okay? Now, let's say you took 8 trades with this trading strategy, but then after taking these 8 trades, 6 of them were losses and then 2 of them were winners. And it so happened that the losses were actually consecutive losses. So you had 6 consecutive losing trades before you had those 2 winners. Now, if you're trading with linear risk management, here's what's going to happen. You're actually going to be down 6% at your worst, okay, on your trading account. And then the 2 winning trades you'd have towards the end of those 8 trade sample size is going to bring you up a little bit to only being down minus 2% on that trading account if you're using linear risk management. Now, here's the thing. If you are trading with the same trading strategy, taking the same trades as someone using the linear risk management technique, but you are using asymmetric compounding instead, you could have 6 losses in a row, which will cause you to be down about minus 6%, but only having just 2 back-to-back winners is going to bring you up to plus 2%. How's that possible, you ask? Well, it's simple, because when you had those losses, you're always risking 1% of your trading account's capital on each of those trades you took. But when you had that first winning trade, it gave you a profit of 2% on your trading account's capital. Now, for the next trade you take, the 8th trade, instead of risking 1%, which is what you would have done with linear risk management, with asymmetric compounding, you are actually going to risk your winnings from the 7th trade, which is going to be 2% since you're trading with a 1:2 risk to reward ratio, as well as the 1% starting balance of this trading account's capital, which you're always risking on each trade you take. So your risk per trade is going to, for this particular trade, is going to be 3%. That's 2%, which is your profit from the 7th trade, and the 1% which you always risk on each trade you take, which will make it 3%. If that 8th trade turned out to be a winning trade, that's going to give you a profit of 6%. So now, with that 6% profit, when you subtract your losses, okay, which is minus 4 at this point, then from the 8th trade, you're going to go from being down minus 4% to being up plus 2%. So this is why it's so... Using asymmetric compounding when you're trying to pass all these prop firm challenges is just so crucial, okay? Because it's going to give you an unfair advantage even if you're trading with a mediocre trading strategy. Just to show you the power of asymmetric compounding, I'm going to show you the outcome of the same strategy, taking 30 trades using 2 different risk management techniques, okay? So for the first one, let's assume that you took 30 trades, okay? And you're trading with a 1:2 risk to reward ratio. Now, this is a trade outcome graph. Assuming you took this 30 trades on, let's say you're planning to take a $25,000 FTMO challenge, okay? So the starting balance is going to be 25,000, and you're trading with a 1:2 risk to reward ratio, meaning you're risking 1% of your account's balance and aiming to make a profit of 2% whenever your trade turns out to be a winning trade. Now, for this particular 30 trade sample size, it so happens that you have a strike rate or a win rate of 47%. This simply means that out of the 30 trades you took, 16 of them were losers and 14 of them were winners. But because you're trading with a high risk to reward to risk ratio, you still ended up making money from this particular sequence of trades. But here's where it gets interesting, okay? For this particular sample size of trades, you're only using a linear risk management strategy. So what I mean by a linear risk management strategy is, for this particular account, whenever you take a trade, you're only risking a fixed amount of that account's capital. So let's say the starting balance of this account was $25,000. You only want to risk 1% of that account's starting balance, which is going to work out to be $250. So if you're risking $250 on each trade you take, and you're trading with a strategy that has a 1:2 risk to reward ratio, when that trade turns out to be a winning trade, you're going to make $500 in profit. Now, there's no asymmetric compounding here. So it's fixed. When you win or you lose a trade, it doesn't matter. You're only risking $250 per trade. Now, here's what the outcome of this trades is going to look like, okay? It's going to be, let's say the first trade you took was a winning trade, the second was a loss, the third was a loss. And because it's not asymmetric compounding, you're not changing anything. You're always risking $250 per trade. Now, at the end of this trade sample size, these 30 trades you took, you're going to end up with a profit of $3,000. Okay? Now, this is a good amount of profit. Okay? But like I told you, asymmetric compounding really gives your trading strategy a very, very big push in its return on investment. Okay, so now let's take a look at the same sequence of trades, assuming it's the same trading strategy, but using a different risk management technique, which is the asymmetric compounding. What's the outcome going to look like? Now, for this outcome, whenever you win a trade, like I told you guys, you're going to risk your winnings and the default risk per trade on that particular account. So for this example, let's say the first trade you took was a winning trade and you're risking 1% of this account's capital on each trade you take with a 1:2 risk to reward ratio. Well, it's going to work out that you're going to be risking $250 to make $500. But now since you've made $500, on the next trade you're going to take, you're actually going to not be risking $250 because your previous trade was a winning trade. So in this regard, you're going to be risking your winnings, which is $500, plus the $250 which you risk on every trade you take, which is 1% of this account's starting balance. And that's the reason why you see that this second trade, because it was a loss, we ended up losing $750 on this trade. But it doesn't matter because you've already worked out the numbers and you know that you're going to take 30 trades for this particular sample size, okay? So even if you had a 30% win rate or a 40% win rate, you've worked out the numbers and you've seen that you still end up either at break even or slightly profitable. Okay, so let's just run through it. Let's say the outcome of this trade sample size was the same as the previous one: win, loss, loss, win, loss, win, win, and then all of that. Now, I want to draw your attention to this. Because this was a winning trade, you made $500, okay, because you're risking $250 to make $500. Now, on the next trade, which you're going to take, you're going to risk that $500 that you made in profit from this trade and the default risk per trade on this account, which is 1% of the starting balance, $250. So you're going to be risking $750 to make 2 times that amount. And this so happened that the second trade was a winning trade, back to back, okay? And so that's why you made $1,500 on this particular trade, okay? And now since you've won these 2 trades back to back, you're going to revert to risking your default risk per trade on this account, which is 1% of its starting balance, okay? Now let's say you kept doing this and you kept doing this. Guess what? With the previous trade outcome graph, even though you took the same trades as this outcome graph, because you used linear risk management strategy with the previous one, you were only able to make $3,000 in profit. But with this particular trade outcome graph, you ended up making $4,000. That's a difference of $1,000, which would be more than enough for you to pass the challenge and also pass the verification and also make a little bit of profit on your funded account. Why do I say this? Because if you're trading on a $25,000 FTMO challenge account, all you need to pass the challenge is 10% of that account, which is going to work out to be $2,500. Now, for you to pass the verification, you need to make only half of that, which is going to be what? $1,250. So when you add $1,250 to $2,500, it's all going to work out to be $3,750. And for this particular risk management model, you would have ended up making $4,000, which would mean that you would have even made an extra $250, maybe on your funded account, and maybe pause trading, wait to get your refund, and then a little bit of that profit split so that you're completely risk-free. Now, the reason why I took so much time to explain this to you is because the risk management aspect of this is much more important than the trading strategy. I'm going to give you the trading strategy which I recommend you use, which is the one I use actually. This is my go-to trading strategy. It's a trend trading strategy. But the thing is, I want you to bear in your mind that even if it so happens that maybe you are not that type of person who likes trading with indicators or using mechanical trading strategies, all you need to do is to find a trading strategy which you're comfortable with, a trading strategy which you've backtested, and a trading strategy which is going to give you an edge over the market, and then use a powerful risk management model like the one which I just showed you, the asymmetric compounding, and then you're off to the races, okay? You can just go out there and do your thing. So with that out of the way, with that said, let me show you the trading strategy and show you exactly how to identify when to buy and when to sell. And then it's going to be up to you to couple that with this powerful risk management strategy to pass any FTMO challenge you so desire. Okay, so you can see that I'm in the MT4 trading platform. Now, the way this strategy works is it uses 3 time frames, okay? The first of which is the daily time frame. The second is the 4-hour time frame. and the third is the 1 hour time frame. Now, the reason why this strategy uses these 3 time frames is because it's aiming to take trades in the direction of the market's predominant trend. Okay, now let's assume that the direction of the trend on the daily time frame is bullish. Well, this trading strategy is looking to take bullish trades in the direction of that trend, but it doesn't use the daily time frame to identify exact trade entry and stop loss levels and all of that, because when you do that, your stop losses are going to be extremely wide because the daily time frame is a large higher time frame. Okay, now the way this works is you are going to be using 3 moving averages. Okay, the first of which is going to be a 60 period simple moving average, which you're going to be adding to prices low. I have a video on how to set up this strategy with live trade example, more than 6 or 7 live trade examples on this channel. You can go and watch them. And I also have over a 1 hour video detailing exactly how to set up your charts to use this trading strategy. Okay, so I'm just going to quickly run through it here. You're going to be using a simple moving average, and it's going to be a 60 period simple moving average. Okay, and then you're going to color it whatever you want. Mine is red. You're going to add the red one is going to be the close, applied to the closing price of the chart you want to trade. Okay, then next, after you've added the red moving average, the 60 period red moving average to the closing price, you're going to add another 60 period simple moving average, but maybe you might want this to be a dotted line if you want it to look exactly like my charts. Okay, and you're going to add it to the high price. Then you're going to add the last moving average to the low price. The reason is because the logic behind this is that if price is trading above all of these 3 moving averages, this simply means that price is in an uptrend. So the reason why we say this is because if price is trading above its average high price over the past 60 periods or 60 candles, and is trading above its past 60 periods for the low price, then obviously it's in an uptrend because it's trading higher than that. And if the opposite was true, then it's in a downtrend. So the way this works is, first you want to see price trading above or below the 360 period simple moving averages on the daily time frame. And then you're going to come to confirm that when price is trading above those same moving averages on the 4 hour time frame, if it was trading above them on the daily time frame. And then last but not least, you're going to use the 1 hour time frame to identify exactly where to get a buy or long trades in the direction of that trend. So as you can see with this example, price is trading above this 360 period simple moving averages, and it's also trading above them on the 4 hour time frame, meaning that the direction of our trend is up. Now on the 1 hour time frame, what we want to see is, first we want to see a candlestick close above the 360 period simple moving averages, which is exactly what we have here. Next up, we want to wait for that candlestick. Okay, we want to wait for the formation of a fractal on that 1 hour time frame, because the fractal is going to point to us the candle which we're going to be using to identify our trade entry level, where we're going to be placing our buy stop pending order. And the 60 period simple moving average, which was applied to prices low in the case of an uptrend, is what we're going to use to identify our stop loss. So as you can see, we have the fractal formed, but we're not going to place our trade yet, because when the fractal forms, it needs 2 candlesticks to form after it before that fractal is going to confirm that it's not going to be repainted. Okay, so we're going to wait for another candlestick to close, and if this candle does not go beyond this fractal candlestick's high, then it's not going to repaint, and then we are going to use that. Okay, now next we have this candle form again, and now this fractal is confirmed. So what do we do now? Well, it's pretty simple. We're going to draw this. Okay, the reason is because this is going to show us at the tip of this candlestick, this is the place where we're going to be placing our buy stop pending order, and our stop loss is going to be placed here. Okay, at the 60 period simple moving average, which was applied to prices low. So I'm just going to adjust that to be at the 66 price, 144.66 price. Okay, here. So now we're risking 1 to make 2. So for this particular trade, we're going to be aiming for a 1:2 risk to reward ratio. And this is where, if we're aiming for a 1:2 risk to reward ratio, this is where our profit target is going to be. So let's quickly take this trade, okay? I'm using a simulator for those of you who are wondering, okay? So let's assume you're risking 1% of your account's capital on this trade, which we've worked out to be $250, because we are using an example of a $25,000 FTMO account, okay? So buy stop pending order, 250. And since we're using the visual mode, our stop loss is going to be placed at the 144.66 price level. Our trade entry is going to be at the 144.94 price level. And then last but not least, our profit target is going to be at the 145.50 price level. Now you can see that we're risking 28 pips and we're aiming for 56 pips as our profit. Okay, so we're risking 1 to make 2. Okay, now I'm only going to click on the accept button, and just like that, our pending order has been placed into the market. So we've done the hard work now. Okay, we are now waiting for price to trigger our trade entry. And if it doesn't, and a new fractal forms, or the price level of this 60 period simple moving averages changes, then we're going to keep adjusting it until either price triggers our trade or it closes below this moving averages, and then we are going to cancel our order. So let's continue. Let's move. Okay. And now our order has been triggered. So we keep going, one candle at a time, one candle at a time, one candle at a time. And lo and behold, price is almost going to hit our profit target. And it just did. Price just hit our profit target. Now, remember what we talked about with the risk management strategy? So we were risking $250, which is 1% of this account's starting balance on this trade, to make 2 times what we are risking. And now we've made that. We've made about $500, almost $500 on this trade. Now, if we want to use this to pass our FTMO challenge, then here's where it gets interesting. On the next trade we are going to take, we are not going to be risking $250, but rather we're going to be risking the profits we made from this trade, which is like $500, and then we're going to add on that default risk per trade which we take on this account, which is $250. So on the next trade which we're going to take, we're going to risk $750 US. And if that trade works out, we'll be risking 1:2. If that trade works out, then we're going to make a profit of $1,500. Now, if that actually does work out, then we're going to end up with a profit of $1,500 plus this $500 which we made from this trade, which is $500. Okay, and then that's going to be 2,000, and then we keep taking another trade again. If we have another winning trade, then it's going to work out to be 250, risking 250 to make 500, and we're going to end up with a profit of 2,005, meaning we would have passed that challenge for this particular example, which is the $25,000 account. Now, if you want to pass your FTMO challenge in only 2 trades, like I alluded to earlier on, then you're going to have to risk more than 1% of your account's capital. The reason is because when you risk 1%, you're going to need to have 3 consecutive winning trades in order to pass the challenge. But if you risk 1.25%, for example, all you would need to do is to get 2 consecutive winning trades to pass the challenge. So let's assume you're risking 1.25% to make 2 times that amount. If the first trade turns out to be a winning trade, then it's going to mean that you're going to have a profit of 2.5%. Now on the next trade, you're going to risk that 2.5% profit with the risk per trade, the default risk per trade which you risk on the account, which is 1.25%. So 2.5% profits plus 1.25%, you're going to be risking 3.75% on the next trade you'll take. Now for that 3.75%, if that trade also turns out to be a winning trade, you're going to end up having a profit of 7.5%. So when you add the 7.5% profit with the previous winning trades, with the profits from the previous winning trade you had, which is 2.5%, that's it. You would have passed the challenge in only 2 trades. But for you to be able to do this, my recommendations will be backtest your trading strategy and then pay close attention to the consecutive winning trades of that trading strategy as well as its consecutive losing trades. So let me give you an example of what I mean. So let's assume this is the backtest result of a trading strategy which I used, okay, one of the trading strategy which I tested. So let's assume that, for example, you want to use this trading strategy for your FTMO challenge. But here's what you want to pay close attention to. The maximum consecutive wins of this trading strategy was around 14 trades. And the maximum consecutive losses was around 14 trades also. Now, if you were taking an FTMO challenge and you were risking 1% per trade, well, guess what? Even though past performances are not necessarily representative of future results, since this strategy in the past has had 14 winning trades and 14 losing trades in a row, it's possible that it could also have them right now. So for example, if you're risking 1% per trade, and this trading strategy happens to be in a losing streak, okay, or the worst losing streak, then you could easily have 14 losing trades in a row, which would mean that you would lose that challenge. But let's say you cut your risk down, okay, to something like 0.5%, then you would still be in the challenge, okay, even with the worst losing streak of the strategy. So before deciding your risk per trade, even though asymmetric compounding really sounds awesome and all of that, before deciding your risk per trade, you really need to backtest the trading strategy which you want to use so that you'll know what you are supposed to risk per trade, okay, with historical data to back that up so that you don't end up blowing your account and you have that data that, okay, if you want to use asymmetric compounding, the trading strategy also has a very high chance of giving you consecutive back-to-back winning trades also. The thing is, if you would like to make an insane amount of profits trading funded prop firm accounts, then passing online prop firm challenges just isn't going to be enough. You're going to need to take your trading skills to a whole new level. And that's why you absolutely need to watch this Profitable Forex Trading Blueprint series, which is a crash course designed to help you become a consistently profitable Forex trader in a step-by-step manner. Just click on the video on the screen now to get free instant access to the crash course.